3 locations, all profitable, growth capital lined up, your pipeline is built, and you're ready to go. You have a conversation with your banker, and he tells you the one word that every single growing operator doesn't want to hear. No. Not because your credit is bad, not because your clinics are underperforming, but because you have reached the edge of their balance sheet. Your personal guarantees are stacked, your debt to income is maxed, and the bank's internal investment committee has decided you, the operator who's printing cash at all their clinics, is just too much exposure. I've helped develop over 100 ground-up healthcare projects across the U.S. I've sat across the table from the banks, from private equity groups, as an advisor to an operator, and as a developer. And I can tell you one thing is certain. Operators who are building 10, 20, 30, 50, or 100 clinics per year, they're not doing it through a bank. They do it through an entirely different capital architecture that most operators do not know exists. Today, I'm dismantling the debt ceiling myth and showing you the exact institutional capital stack that removes bank dependency and replaces it with a system designed to scale. Before we get into the solution, you need to understand why the bank says no. It's not personal, it's structural. And frankly, they're just doing their job. You are asking them to do a job that they were never designed for. Commercial banks operate under concentration limits. Their regulators, the OCC, the FDIC, well, they restrict how much any one borrower can represent on their books. When you hit 3, 4, maybe 5 locations with personal guarantees, maybe an SBA or conventional loan against them, well, you're starting to bump up against those limits. The bank may not be able to physically lend you more money even if they wanted to. And here's the part that nobody's telling you. Your personal guarantee is not just tying up your borrowing capacity at that bank. It is showing up on your personal financial statement that you submit to any potential lender, any potential partner, or any potential private equity group that's underwriting your portfolio. You are not just stuck at that bank. You are kind of stuck everywhere. The operators who break through this do not fight the bank. They do not go out and search for a more aggressive lender. They simply change the architecture entirely. They move from personal credit to institutional capital. And the difference is not incremental. It is absolutely structural. The first move is one that I've talked about before. But today, I'm actually going to show you the capital math that most people miss. And more importantly, why the developer wants this deal just as much as you do. When you build a clinic yourself, here's where the money goes. Land, $765,000. Shell construction, $800,000. Interior build out, $500,000. Site work, $600,000. Soft costs, $150,000. Signage, $125,000. Interest carried during construction, we'll give it $60,000. Operations, so staff, equipment, marketing, we'll call that $300,000. For a total of $3.3 million per clinic. In a build-to-suit structure, the developer is responsible for the real estate stack. They cover the dirt, the vanilla shell, possibly the interior build-out, any due diligence costs, carrying costs, and many of the others. That's $3 million that doesn't come out of your pocket. What you cover is the operational costs. Let's call it $300,000 for the staff, the equipment, and building a patient acquisition engine. Now, why does the developer want this type of arrangement? Because a high credit healthcare tenant paying on a triple net lease is one of the most attractive investments in commercial real estate. Your revenue is insurance backed. Your lease term is typically 10 or 15 years with options. Your rent coverage ratios are strong. The developer is not doing you a favor. They're building a stabilized, institutional grade asset that they can hold for cash flow or sell in the future to a REIT at a good cap rate. Both sides of this deal are getting exactly what they want and need. 3.3 million divided by 300,000 equals 11. With the same capital that would give you one clinic where you own the building, you can have 11 clinics where you own the market. And here's what changes. Instead of personally guaranteeing 2.5 million in construction debt per location, you're guaranteeing a lease obligation. That personal guarantee can be structured with a burn down so your exposure drops to 20 to 25% per year as the location stabilizes. You still have skin in the game, but the nature of the exposure is fundamentally different, and it does not trigger the same concentration limits on your bank's balance sheet because it is an operating lease, not a debt instrument. You just funded 10 additional clinics without borrowing a single dollar from the bank. You use the developer's capital. The developer's capital replaced the bank, and your personal guarantee exposure went down. Your unit count went up, your market density, which is what private equity buyers typically pay a premium for, exploded. And the developer now holds 11 stabilized net leased assets with a credit-worthy tenant. That is a deal structure where everybody is playing offense. But the build-to-suit model only works if you have capital for the operations layer. And what if that capital is trapped somewhere? Well, that brings us to pillar 2. If you own the real estate on your first 2 or 3 deals, you are sitting on what I call dead equity. It is real, it is valuable, and it is doing absolutely nothing for your growth. Now a caveat. Owning the real estate isn't always wrong. If you're a single location operator, owning your real estate can be a fantastic wealth building tool. The equity appreciates, the mortgage pays down, and eventually you own an asset free and clear. That is a legitimate path. But if your strategy is to become a multi-site operator, that ownership strategy becomes an anchor. The calculus changes the moment that your growth ambitions outpace your capital liquidity. Knowing which mode you're in, that's the skill that separates operators from amateurs. Here's a concrete scenario for the scaling operator. You own 2 buildings. The appraised value for both is $2.4 million. You owe $600,000 on the mortgage loan. That means you have $1.8 million locked inside walls that are already producing revenue. That equity is not hiring your next provider. It is not funding your next build out. It's not acquiring patience. It is frozen. A sale-leaseback converts that equity into liquid capital. You sell the real estate to a net lease investor, a REIT, a family office, maybe a 1031 buyer at market value. You sign a long-term triple net lease to continue operating like normal. You pay off the remaining mortgage. You walk away with $1.6 to $1.8 million in cash, typically between 60 and 120 days. And understand, the buyer in this transaction is not doing you a favor either. They are acquiring a cash-flowing, triple net lease healthcare asset with operating history. For a 1031 buyer, this is a premium replacement property. For a REIT, this is exactly the asset class that they're pursuing. The buyer gets a stabilized, long-term income stream, and you get liquid growth capital. Both parties are executing their optimal strategies simultaneously. Now do the math. 1.8 million divided by 300,000 per operational launch equals 6 additional locations. You just went from 2 owned clinics generating revenue to 8 total clinics generating revenue. And you did it without a bank, without adding additional personal guarantee, and without borrowing $1 of traditional debt. But the objection always here is, but now I'm paying rent on a building that I used to own. Yes, you are. And your rent is a fixed, predictable, tax-deductible, operating lease expense. Your equity was a frozen, illiquid, non-deductible asset just sitting on the balance sheet. You traded a static asset for a growth engine. That is not a loss. That is a capital reallocation. Now, if you're watching this and you're thinking, I understand the architecture, but I don't have the relationships or the infrastructure to do this. Well, that's exactly where I come in. Whether it's developing your next 5 or 10 locations on a build-to-suit basis, or structuring and executing a sale-leaseback for locations that you already own, or maybe you want to position your growth for institutional capital. I work with healthcare operators who are ready to move past the bank ceiling and build real infrastructure. I sit in the middle of these deals because that is where the deals actually get structured correctly. When someone at the table understands the developer's math, the lender's risk calculus, and the operator's timeline for growth simultaneously. Click the link in the description for a direct strategy session. 30 minutes, no pitch. We look at your current capital structure and identify which of these pillars will help you on your next phase of growth. Now we're not done, so let's get back to some strategies. Pillars 1 and 2 handle the real estate side. But what about the operational capital? The $300,000 per site for staff, equipment, and patient acquisition. If you're opening 5 or 6 clinic locations simultaneously, that's 1.5 to 1.8 million in capital deployment. Where does that capital come from if the bank already said no? This is where private credit enters the building. Private credit is non-bank lending. Specialized funds that lend against your business fundamentals, not against your balance sheet. They typically care about 3 things: your 12-month trailing EBITDA, your revenue and profitability per location, and your patient volume trajectory. Your FICO score becomes secondary. Your personal balance sheet becomes secondary. What they are underwriting is the platform, not the person. In 2024 and 2025, private credit deployment into healthcare businesses hit records. These lenders have figured out what your local community bank has not. Medical revenue is contractually reoccurring, insurance-backed, and recession-resistant. A 3-location dental practice doing $4 million in top-line revenue, that's a better credit risk than a 50-unit apartment complex. And private lenders are starting to price accordingly. The typical structure: a revolving credit facility or a delayed draw term loan. Size to your expansion plan. You draw capital as each new location hits specific milestones: lease execution, build-out completion, patient volume ramp. You are not paying interest on money sitting idle. You are deploying capital in lockstep with revenue generation. Now, private equity is not free money. The cost of capital is typically much higher than a traditional bank. You might be looking at 10 to 14% versus 7 to 9% from a conventional lender. But you are not comparing interest rates in a vacuum. You are comparing the cost of that capital against the revenue that you could make opening 6 clinics 12 months faster than if you went through a conventional bank. When you run the math on the accelerated time to revenue, the spread between a traditional bank rate and private lenders is almost always covered by the incremental cash flow. Almost always, not always. You need to run your own numbers, but directionally, speed has value, and private credit lenders, they understand that. Personal guarantee structure is also different. Private credit facilities are typically secured by the enterprise, your LLC, or your operating entity. The personal guarantee, if it exists at all, is often limited and typically burns down as the platform proves itself. You're building scale without stacking personal exposure. Let me show you what this looks like assembled. You're at 3 locations, the bank just said no. Here's your next 18 months. Month 1 through 3, execute a sale-leaseback on your own real estate. Walk away with $1.6 to $1.8 million in liquid capital. Simultaneously engage in private credit fund to underwrite a revolving facility against your trailing EBITDA. Month 2 through 6, engage in a build-to-suit developer for your next 6 to 8 locations. They begin site selection, entitlements, and permitting on a parallel track while you focus on recruiting providers and building your operational playbook for growth. Months 6 through 18, operations team in place, locations begin delivering, you deploy $300,000 per site from your sale-leaseback proceeds and your credit facility. By month 18, you are operating 8 to 11 locations. You went from 3 locations to double digits in a year and a half. No bank, no new personal guarantees, no personal balance sheet exposure. The debt ceiling is not real. It's a constraint that only exists inside the dynamic of traditional banking. The second you step outside that architecture, well, that constraint disappears. Build-to-suit shifts real estate capital off your balance sheet, and it gives developers a cash-flowing, stabilized asset that they can hold on to or sell. Sale-leaseback convert debt equity into growth capital and give investors the exact income stream they're chasing. Private equity underwrites your platform, and it gives specialized lenders a durable, reoccurring revenue stream that they price at a premium. Every piece of this stack works because both sides are getting exactly what they need. That is not a coincidence. This is exactly how institutional quality deals are designed. Do not let the bank's balance sheet dictate the size of your platform. I'll see you on the next one.